When it comes to investing, there are several traps that you want to watch out for. This is not an extensive list, but we're going to go over 3 of the main traps that many people fall into when it comes to investing, comes to understanding the stock market. My name's Nate. I'm a popular investor on eToro. If you're looking to get started investing, comment below. eToro is a great platform. Been investing on there for several years. I've been investing for 10 plus years. This is not financial advice. I don't know your exact circumstances, but these are my personal experiences. These are things I've gone through, emotions, feelings, different things like that. And I just want to share what we do in our investments and with our investment journey to maybe help you along your way. So let's jump into the video. The first one is what I call the gap trap. Now, in the stock market, in investing, there's the pre-market and aftermarket. Most people can't invest in those times. You can't close positions or buy or open new positions in the aftermarket or the pre-market. In between, when the market is open, you can open positions and you can close positions, all that kind of stuff. But the gap trap is thinking that you can place an order when you've seen movement happen after hours or before hours. For example's sake, let's take the stock of Apple. Okay, let's say it's going to report earnings after the market's closed. So you don't own any Apple, let's say that, right? You don't own any Apple, and then it reports its earnings after the market has closed in the after hours, and you see it jump 10%. You're thinking, oh, I want in on that. So you set an order to open a position, you put money in. The position will open when the market opens the next day or the next week if it's a weekend. So when the market opens the next day, it will open your position. And you'll see the after hours a 10% jump, and then you'll see the pre-market is still up 10%. But it won't place your order until the market opens. So your order will actually be made 10% higher than what it was the previous day. So let's say market opens, your order's executed, and you've now purchased at the top of that 10%, and then during the day it settles back down and declines from the 10% to a 7% gain. So for the day, Apple's had a 7% gain. Great, except your position has had a 3% decline. That's what happens in your position, but the stock has had a 7% gain. That's the gap trap. And a lot of people fall for it and will try to open positions or close positions. Let's say you have positions in Apple, right? And it drops 10% in the aftermarket or in the pre-market, and you think, let's close. And so you set it to close. Now, it won't close your position until the market opens, because things aren't happening yet. The market will open and then your position will close, but it's going to close after that 10% decline, okay, after that 10% drop. And then it may jump up. It may jump up a little bit, so where it finishes the 7% decline, but you've closed your position and locked in your position at a 10% drop, because it executes as soon as the market opens. That is called what I call the gap trap. And the reason I call it the gap trap is because the movement from a stock price when the day closes to what the stock price when the next day that the market is open is what's called gapping. And so it's called gapping because it jumps. It can jump up several percent or jump down several percent. And so that's the gapping movement. You can't do things in those hours. Now, some people can make a little bit of adjustments in extended hours and things like that, but majority of people cannot trade and move positions around in the aftermarket or the pre-market of the next morning. So be careful of the gap trap. The second the second risk to investing, and not really risks, but things that can make your investment journey not as enjoyable, is FOMO. Everyone knows what FOMO is, and most people know it's fear of missing out. And so this is where FOMO can set in. You can see a massive run, be it in crypto, be it in Nvidia, which we've seen recently, be it in all kinds of things. Fear of missing out, and so you jump in and you put money into work, and you jump in and it's risky, because you're oftentimes, we're going to touch on this in the next part, but you're oftentimes not sticking to your game plan, and you want to stick to your game plan. You want to know what your plan is. Stay within the boundaries of your strategy and what you're striving for, what your end goal is. If you're investing with FOMO, usually means emotion is taking control, and emotion steering your investment journey. And so you want to know what your plan is and execute the plan. Okay? Oftentimes with FOMO, you start putting money in as well that you need to live on, or that's part of your emergency fund, not money that you had set aside specifically for investing. So be careful of this happening, seeing crazy gains and crazy things going on, and you just worry about missing out. So you got to jump in. No. If like for us, we deposit every 2 weeks and invest out of each paycheck. If things are happening in the market in between, we do not take money out of our bank account or out of our emergency fund to try and put in there. And over the long run, it's not going to make a huge difference. Okay, so don't let FOMO set in. The third one is kind of a two-part one, is being too rigid, or too flexible. Okay, so rigid means you aren't willing to change your plan, you aren't willing to adjust. Rigid means you are stuck to your plan and you're not willing to adjust. Being too rigid, it's like, nah, this is it, and it's not working, but this is the plan, this is the strategy. And you've got to have a strategy. Okay, that's good, you've got to have a strategy, but you can't be too rigid about it. And then also, likewise, on the other side, being too flexible. Okay, so if your plan is always changing, if your plan is always adjusting, then that's not good either. Okay, you got to give your strategy a time, and this is where going in with a plan and understanding what you are doing is important. Doing a lot of research and understanding. Another thing is always invest in things you understand. If you don't understand it, don't invest in it. Okay, that will help you build your plan. So don't be too rigid to where it's like, no, we don't change. We stay the course no matter what. Okay. Now there are some things that, yeah, these are the foundations, and those don't change. And one of those is, for us, is the consistency. When a paycheck comes in, we deposit, we invest. That's foundational. That doesn't change. But you've got to be willing, if something's not working, or if you see opportunity on the horizon elsewhere, you see this or that, you've got to be willing to adjust things a little bit. For example, earlier this year, I saw that the yen to the Australian dollar, the yen had weakened incredibly and hadn't been, this year 2024 hadn't been that weak since 1990. So I was like, well, this is almost a bit of a no-brainer. Chuck some money in, buy a bunch of yen, okay? Because it's most likely only going one way from here, and that's up. And so we're able, over the course of 3-4 weeks, it bounced back, turn a good profit from that, okay? I don't do a lot of currency investing, but I saw an opportunity there. And even though I'm not a currency person, a currency investor, saw the opportunity, and I wasn't rigid to the point that I couldn't take advantage of that. So I took advantage of that. But you don't want to just be going with always changing every day, moving here, moving there, and this week we're here and next week we're over there, and we're buying this and we're buying that, and we're so flexible and fluid that nothing gets to set in place. If you're going to plant something, plant it, give it time to grow. Don't be so flexible. Don't be so flexible that you never set in on any one thing. These are, you've got to be kind of a mixture of these two. Okay, have your solid foundations, and when you see opportunity, step into that opportunity, but don't be changing things all the time. Ride the ups and downs. You're going to have waves no matter what you invest in. Okay, ride the roller coaster. The only people that get hurt on a roller coaster are those people that jump off. Hey, thanks for watching. If you've experienced any of these, comment below. If you have a video or something you'd like to discuss, I have a question, comment below. I'll do a video on it. And yeah, thanks for watching. If you haven't followed along or subscribed yet, love for you to follow and subscribe. We'll see you in the next video.